Have you ever wondered how the phrase, "let your money work for you," can become a reality? Well, look no further. Learn how to harness the power of saving and investing to create a life of financial abundance. In our past videos, we started building the blocks of your financial success. We explored how to set clear goals, track your money, and create a budget that works for you. Plus, we shared practical tips to boost your income and turbocharge your wealth-building journey. And let's not forget those in-depth discussions on different saving options, helping you choose the best approach to reach your unique financial goals. The next step is where real transformation begins: investing. Investing harnesses the power of compounding to grow your wealth exponentially over time, setting you on a path to long-term financial success. Compounding refers to the process where the value of an investment increases because the earnings on an investment, both capital gains and interest, earn interest as time passes. To truly grasp the magic of compounding, let's consider an example. Say you invest $10,000 at an interest rate of 7% per year. Without compounding, you would simply earn $700 annually. But with compounding each year, you earn interest not just on your original $10,000, but also on the accumulated interest. By the end of 10 years, your investment would have grown significantly more than simple interest could ever achieve. This is the transformative power of compounding. It turns time into your greatest ally. Let's see how the power of compounding works with different interest rates. Consider investing $10,000 every year for 10 years. Here's the outcome for 3 different interest rates. Now, let's discover the investment options that can deliver these impressive returns. First up is stocks. Stocks represent ownership in a company. When you buy a stock, you are purchasing a small piece of that business, known as a share. Investors buy stocks in hopes that their value will rise over time, allowing them to sell for a profit. Many companies pay regular dividends, offering income even if the stock price fluctuates. Stocks are a key part of long-term wealth building but come with risks due to market fluctuations. When investing in stocks, 2 major analysis methods help guide decisions: fundamental analysis and technical analysis. Fundamental analysis focuses on the company's financial health. It looks at metrics like revenue, profits, and business model to find a stock's intrinsic value. On the other hand, technical analysis examines price trends, charts, and patterns to predict future price movements. It relies on market data rather than financials. Combining both analysis can help investors make more informed decisions about what to buy and when to buy or sell stocks. Typical stock investment strategies include growth investing, focuses on stocks expected to grow faster than average. Value investing targets undervalued stocks with potential to increase in price. Dividend investing focuses on stocks that pay regular dividends. Ready to start your investment in stocks? Subscribe and stay tuned for an in-depth video on stock analysis. If investing in stocks is not your cup of tea, then let's look at mutual funds. A mutual fund is like a financial potluck. Everyone chips in their money, and a professional manager invests it in a mix of stocks, bond, or other financial instruments. Now, there are different flavors of mutual funds. Equity stocks. These invest primarily in stocks. The goal is to achieve capital appreciation, and they tend to have higher risk but also the potential for higher returns. Bond funds. These focus on investing in bonds and aim to provide regular income with lower risk than equity funds. However, bond funds are sensitive to interest rate changes. Balanced funds. These invest in a mix of stocks and bonds to balance risk and return. They aim for both capital appreciation and income generation, making them more conservative than pure equity funds. Index funds. These passively track a specific market index. They have lower fees and aim to match the performance of the index, offering broad market exposure. Sector and specialty funds. These focus on a specific industry, for example, technology, healthcare, or a theme, for example, socially responsible investing. They are high risk due to concentrated exposure, but can offer high returns if the sector performs well. International and global funds. These invest in companies outside the investor's home country. These funds offer diversification but come with risks such as currency fluctuations and political instability. Whether you are looking for growth, income, or just a safe place to park your money, there's a mutual fund for you. Stay tuned for a detailed video explaining different mutual fund types and how to pick the right one for your financial goals. Next up are ETFs. ETFs, or exchange-traded funds, are investment funds that allow you to invest in a diversified portfolio of securities like stocks or bonds, and they trade on stock exchanges, just like individual stocks. Let's look at how ETFs can help you build wealth. One of the standout benefits of ETFs is diversification. By tracking indices like the S&P 500 or a Nifty 50, ETFs spread your investment across hundreds of companies, minimizing the impact of any single stock's performance on your overall portfolio. Another advantage is cost. ETFs generally have lower expense ratios compared to actively managed mutual funds, meaning more of your money stays invested, potentially growing over time. ETFs are also incredibly accessible. Traded on stock exchanges, they're easy to buy and sell through a brokerage account. Whether you're interested in specific sectors, geographic regions, or investment strategies, there's likely an ETF that aligns with your investment goals and risk tolerance. But remember, while ETFs provide diversification, they're not immune to market risks. The value of your investment can fluctuate with the market. Be mindful of trading costs. Using a discount broker can help reduce these expenses. Also, it's crucial to compare the expense ratios across different ETFs, even though they typically have lower fees. In conclusion, ETFs are a great option for both new and seasoned investors, looking for a simple, cost-effective, and flexible way to diversify their portfolios. Now, let's talk real estate. Real estate has a solid history of appreciating in value. This means over time, your investment grows, adding to your long-term wealth. Then there's passive income. Owning rental properties can provide a consistent cash flow to supplement your income. What's fantastic about real estate is leverage. You can buy properties with borrowed funds. This allows you to invest with less capital upfront. And let's not forget diversification. Adding real estate to your investment portfolio can reduce overall risk. Now, let's talk about types of real estate investments. You have got residential properties like single-family homes, apartments, and vacation rentals. There are commercial properties, office buildings, retail spaces, or warehouses. And for those who prefer a hands-off approach, there's REITs, Real Estate Investment Trust, traded on the stock exchange. Then there's raw land, develop it, sell it. Don't forget real estate crowdfunding, where small-scale investors pool resources for big projects. Real estate investment has some awesome pros. Stable income from rentals, appreciation of property value, control over your assets, and sometimes an inflation hedge. But it's not all roses. There are high upfront costs. Real estate is less liquid than stocks, market risks exist, and active management of rental properties. So how do you succeed? Do your research, understand local market trends and property values. Start small, perhaps with a single-family home or duplex. Location is key. Choose areas with growth potential. Understand financing and secure favorable loan terms, and always have an exit strategy. Most important, if the returns from property investment is not beating your fixed deposit returns or beating inflation, then think again. With the right strategy and understanding, real estate offers multiple pathways to financial freedom, whether through rentals, appreciation, or passive investments. Now, let's talk gold. In a world full of economic twists and turns, this asset shines through the chaos. It's not just a shiny metal, it's a rock-solid investment. For centuries, gold has been valued for its beauty, rarity, and durability. When stocks tumble and currencies wobble, gold stands firm. Why? Because gold isn't just numbers on paper or a screen, it's tangible with intrinsic value. While it doesn't pay dividends or interests, its stability is golden. Gold can help protect against inflation, as its value tends to rise when prices are increasing. It's a shield against currency devaluation. Remember though, gold isn't flawless. Its price can fluctuate with global demand and supply, geopolitical events, central bank policies, currency exchange rate, and inflation rate. For example, gold prices in India are influenced by a complex interplay of global and domestic factors. Globally, gold is primarily priced in US dollars, meaning fluctuations in the dollar's value directly impact gold prices. Gold holds significant cultural importance in India, especially during festivals and weddings. This consistent and high demand pushes prices upward. India imposes significant import duties and taxes on gold, which adds to the final cost for consumers. A weaker rupee makes gold more expensive for Indian buyers. These combined factors often result in gold appreciating more compared to the US. As the world evolves, gold is likely to remain a valuable asset, offering stability and security in an uncertain future. So next time the market gets choppy, think gold, your best bet in economic uncertainty. If you are an investor looking for a hidden gem, silver might just be what you're looking for. Let's explore why. Silver has been a sought-after investment for centuries. Like gold, it acts as a hedge for inflation, keeping your purchasing power intact when currencies wobble. But silver's story doesn't end there. Thanks to its wide use in electronics, solar energy, and medical devices, silver's industrial demand keeps it valuable. And guess what? It's more affordable than gold, making it easier to start small and grow big. Let's not forget, silver is a finite resource. As it becomes scarcer over time, its value could rise, rewarding those who hold on to it. Plus, unlike digital assets, silver is something you can hold and feel. It's a tangible asset that offers a sense of security. However, like all investments, silver comes with its own set of challenges. Price volatility is a significant concern. Silver prices can fluctuate more than gold, presenting both opportunities for high returns and risks of substantial losses. For those considering physical silver, there are additional costs for storage and insurance. Furthermore, silver's price is subject to fluctuations in industrial demand, which means economic downturns can impact its value. In summary, while silver offers unique opportunities for investors, especially as a hedge and a diversification tool, it's vital to carefully weigh the pros and cons. Silver is often best as part of a diversified portfolio rather than a core investment asset. Align your investment decisions with your financial objectives and risk tolerance to make the most of what silver has to offer. Lastly, let's talk about cryptocurrency. It's the hot topic on every investor's mind. With giants like Bitcoin and Ethereum leading the charge, crypto promises high returns and revolutionary changes to our financial systems. But here's the kicker: this asset class is insanely volatile. Cryptocurrency is a type of digital or virtual currency that uses cryptography for secure transactions. Unlike traditional currencies issued by governments, cryptocurrencies operate on decentralized networks based on blockchain technology. But this also means it's subject to massive price swings and regulatory uncertainties. Remember that infamous Bitcoin crash? Security is another big issue. Sure, blockchain is secure, but crypto exchanges not always. Hacks and scams are real threats. So, what's the play here? Diversification. Don't put all your eggs in the crypto basket. Assess your risk tolerance and think long-term. Crypto could be the future, but it's not without its gamble. Invest wisely, and may your crypto journey be smooth. All these investment options have the potential to deliver long-term growth, though some carry higher risks than others. It's crucial to align your investments with your long-term goals and risk tolerance to achieve the right balance in your portfolio. In our next video, we'll explore how to assess your risk appetite and the steps to effectively allocate your assets. Happy investing!